Good afternoon, everybody. I'm Alex Goraieb. I look after FX and corporate treasury at Thomson Reuters. So active management, does it help? There's a lot to really talk about here. So I've been given 15 minutes to do it in. So it's going to be a bit of a fast-forward roller coaster ride, but seeing we're in Copenhagen and we have Tivoli World down the road, it's actually quite appropriate. So there's three things I want to focus on during the next 15 minutes. The first one is to talk about what's happening in the market generally. We're going through unprecedented change, and it might make you reconsider how you currently have set up your hedging programs. The second thing I'd like to do is look at a number of options and considerations that you should look at over, I would say, the very, very up-and-coming future, because there are some decisions I believe you need to make in the shorter term. And then I'll finish off with a number of, some conclusions from myself and my point of view, but it'd be interesting to hear in the Q&A after yours as well. So first of all, in terms of the market and the trends and the roller coaster ride, as I'd like to call it. So, the first thing is the R word. The word I think that everybody uses at least probably 10, 15 times a day, and that's regulation, right? Number of regulations. So let's start, Basel III, the pressure that's put on balance sheets of banks and their appetite to absorb risk on the balance sheets. Volcker rule, which kicked in July, making the banks justify client trades and not prop. Going forward, MiFID II. The reality is this is all translated into all the banks reconsidering how they provide liquidity to the market, and indeed how much of their balance sheet they want to put at the service of providing liquidity in the market. What we've seen is that the concentration of liquidity has really gone to the top market makers, probably the top 10, 15 banks that are willing and have large balance sheets to put at the service of their customers. There's been a huge shift of a number of market makers that essentially move away and move towards more of an agency model where they service their customers and they back-to-back, but they're not providing genuine liquidity, if you will. In fact, all this is made even worse if you think about the whole concept of internalization, because these top 10, 15 banks at the top of the liquidity generation internalize in the region of about 80% of their liquidity. All of that is matched internally before they go to market and before they produce liquidity in the primary market, if you will. Us at Thomson Reuters, we run a number of venues, both primary and secondary markets, and so we keep a very close eye across the board in both the primary and the secondary market to try to understand what is happening with liquidity across the entire market. So, structure, right? Agency or principal. There's a lot of talk around this. The reality is the principal market makers, the principal liquidity providers, those top 10, 15 are taking a bigger slice of the cake, arguably. The vast majority are moving more towards an agency model. If they haven't already done it, they're seriously considering it. The hybrid, if you will, so the niche specialists in, say, Scandies, specialists in Turkey, South Africa, Israeli shekel, domestic large regional players, we'll have a hybrid because ultimately they have balance sheets that they'll put to service their customers in their core specialty currencies, but certainly G10 they'll back-to-back with the larger liquidity providers. And it has got an impact on the market. I mean, if you look at Euro, for example, there were about 400 banks making markets in Euro not so long ago. We estimate there's about 20 doing that now, real liquidity. These banks essentially not just, they provide Euro liquidity, but they also internalize a lot of the flow, and that's having an impact, which I'll talk about in a second. So whilst there's, some liquidity going out, the good news is there's some liquidity coming in as well, and there are new entrants, particularly in the hedge fund space. So, the likes of Citadel, Jump, these sort of companies, which essentially are providing new liquidity to the market. But the question mark in terms of some of these liquidity providers is indeed whether they're committed to providing liquidity to consumers like yourselves in the bad times as well as in the good times. At the end of the day, they have a P&L and they're trading this on a proprietary basis. So, there is the risk that when there is a big shift or change or jump in the market, all bids or offers will be on the same side of the market, effectively creating a liquidity crunch. The other thing we've noticed is the relationship or the relative growth of speculative flow from these new entrants versus traditional trade-backed flow. And it's certainly, in terms of relative growth, the relative growth has been on the speculative flow, which is essentially making this issue a little bit worse of liquidity crunch when something happens in the market. I'll try to expand on that in a second when I talk about liquidity. Essentially, what we're looking at is this trinity, right? You've got liquidity, you've got volatility, and then you've got volumes traded in the market. And those three really interact with each other. And depending on the, priority of the players, they'll have a different impact on the market. Underpinning all of this, right, is conduct. Now, so all of this really started with conduct. The banks have had fines, we've seen that. You've got the LIBOR scandal, you've got the WM fix issues, very well documented, WM Reuters fix, which we've worked very closely with the regulators to amend based on their recommendations. So the Financial Stability Board put out their recommendations around the WM fix. We've moved it from a 1-minute window to a 5-minute window, which certainly has reduced some of the extreme volatility that we used to see in the market during that fixed window, and that has improved things. Whether it's enough, you need to be the judge of that. But there's more, actually. Also, the Bank of England and the Fair and Effective Markets Review are making recommendations around last look, for example. That's a big topic at the moment. Last look is essentially the practice by which when you request a quote from your banks, they take a certain amount of time to check credit, check market conditions before you get filled. So the question mark there is whether that's right. And what's the consequence of removing that? Because there is a consequence to removing effectively what's a safety net, a credit safety net in theory. And the consequences are wider spreads, which aren't desirable either for you. So it's getting the balance right. It's making sure that if there is a last look, it's a fair last look and made for the right reasons. So in a nutshell, what's all this leading to? This is effectively leading to a situation where liquidity is coming increasingly at a premium. For all the reasons I've mentioned, there's an increased demand for a tighter or a tightening supply, which can only lead to one thing, and that's essentially volatility. I would argue bad volatility or different volatility. The other thing are these air pockets I mentioned earlier. We've seen on our venues where, for example, euro-dollar in European trading hours, the most liquid currency we have in this region across the Eurozone, I would say, we've seen gaps after 3 bids of 50 million, which is not a huge amount of demand in the market to make the currency move. And these are, these air pockets, if you will, translate into one thing for you when you want to execute a trade of a sizable amount, and that's slippage, effectively. In fact, Morgan Stanley if I had a paper out a few months back where they analyzed slippage this year versus last year, and the magnitude of slippage they recorded on a 20 million euro-dollar trade, which is not a lot of money, is in the order of about 67%, I think the number was, or thereabouts. That means the amount of slippage experienced by a firm going to market with a 20 million euro-dollar trade increased by 67%. Again, I mentioned earlier, the relative growth of speculative trading versus trade-backed flow, potentially resulting with all trades being on the same side of the market, which doesn't help, particularly when you have to execute a trade. Finally, there's this advent of the liquidity mirage, which is spoken about to a fair extent. Now, you may or may not have experienced this, but certainly if you're using multi-bank venues or certainly aggregators where you can view the liquidity across a number of venues through a liquidity aggregator tool, it is a phenomenon whereby liquidity providers submit their liquidity to a number of venues, and when it's consumed on one of the venues, it may disappear on the others. So whilst you had a view that liquidity was available or more liquidity was available in the market, you can suddenly see it fizzle away. Again, it all translates to this concern around slippage. So what does that mean, right? A couple of quick conclusions, if you will. from this perspective. So the first one is, there's a lot more consideration when choosing venues, liquidity venues, both for the producers of liquidity, those that provide it onto the platforms, making sure if liquidity is at a premium, they are playing in the right places, right? Similarly, as from a best execution perspective, as liquidity consumers, you want to do the same thing. You want to make sure you're in the right venues, taking liquidities from the right partners. The other thing is execution management tools. We've heard on a few of the sessions, in fact, we had a session earlier with Kona around best execution and execution management. Increased use of aggregators, right? Because the technology has been commoditized. Increased use of smart order routing to the right venue where you think you can find the liquidity you need. Again, it's a matter of magnitude, but I'll come on to that. Increased use of algos, things like trade-weighted average price, so you can trickle an order in if it's particularly large and it doesn't impact that market. You're looking for market impact to minimize that so you don't get the slippage. At the end of the day, if the banks are not warehousing the risk or they have less of an appetite to warehouse the risk, that risk needs to go somewhere. And essentially, it's coming your way. And so to answer the question of active or otherwise, there is no simple answer to this. One size does not fit all, but it's something you need to consider because there are changes in the market that are affecting liquidity, and the transfer of that risk is going to the buy side, whether corporate or otherwise. So something to think about there. And in terms of what to think about, considerations, right? What to think about, what to prepare for. The sooner you start preparing, the better. The sooner you start thinking about some of the options, the better. So the first one is definition. Clear definition of your FX risk mitigation policies across the board. And there's a number of things you can look at. Like the first one is your supply chain and natural hedges. That's arguably the most active form of hedging that you could practice, and that is making sure that your costs and your revenues are currency matched where possible, depending on where you procure, the raw materials and everything you need in your production side versus where you make your money. Not an easy thing, particularly for a global organization. Particularly, again, in the previous session, we saw this great dispersion of where revenues are earned versus where products are manufactured. Second one is around use of multilateral platforms. So again, best execution. At the end of the day, right, the trend is to, I've heard this, I heard a session yesterday on liquidity, I'm trying to think what the phrase they used. In fact, I can't remember the exact phrase that was used. It was a very interesting session in terms of maximizing the potential of your liquidity. But what there seems to be a drive against is bank agnostic venues where you can essentially leverage your power as a customer with all your relationships. And some questions to ask yourself in a multilateral framework. So if you are, for example, need to take liquidity in Turkey, do you do it here if you're a producer within, say, the Nordics, i.e. Scandinavia? Do you go to London for that liquidity, for dollar Turkey, for example? Do you go to Istanbul? It's worth reviewing the choice, and multilateral venues allow you to access all of these liquidity providers or liquidity from different providers in different locations in one location in a very simple manner. The other one are MIS tools. So MIS tools are management information service tools which allow you effectively to measure the effectiveness of the service you're getting from your banks over a multi-bank portal. So in a given currency, at a given time of day, with given market situations, how well are your banks giving you fills? How often are they letting you down? Are they guaranteeing you fill? Are they really putting their balance sheet to work for you? And whilst an MIS tool is a post-trade tool, right? So it's after you've traded with them. The reality is that it's also a pre-trade tool because part of your hedging policy, particularly if it's active, is to know where to go in times of need for which currency and having that all planned out so you don't have to think at the time it's all planned out. Order management is the other one. So the ability to aggregate all the orders, if you have a hub and spoke model, from all your subsidiaries to head office, net those trade out, and effectively and efficiently execute against a number of providers that provide you liquidity. So netting of cash. The other thing also is new technology. So Sophisticated electronic trading. This is technology that's here now that you can deploy tomorrow. Again, depending on scale. It's not for everybody, but electronic trading, for example, allows you to create a central bank in central treasury that distributes liquidity to all the subsidiaries in an automated manner. It allows you to net, allocate, and execute back-to-back without a human being in theory. I'm not saying that's where we go. That's the other extreme. But that technology is here and now, and is being used by some of the very large corporates, as was previously with just the banks. Algos, I mentioned algos earlier. I mean, I read something the other day. BNP stated that algos have tripled in use since the beginning of this year. So what they've seen previously to this year is a tripling in the number of their bank algorithms, right? Which obviously the buy side generally is looking at very deeply into how these products work and how they reduce slippage, and are increasingly concerned at looking at this because they understand they need to be a lot more active in terms of managing their day-to-day FX risk. Data is the other one. So, let technology providers do heavy lifting for you. On the data side, there's a number of tools that a number of providers, including ourselves, provide. So I mentioned earlier we run venues, buy and sell side venues, the primary market and the secondary market, and we understand where the liquidity is in which currency at what time of the day. This is what we do. So ultimately, something like a liquidity heat map, very simple. It simply tells you that for the next 24 hours or in the last 24 hours, which is the most liquid half an hour period in that day for a given currency. So if for whatever reason you need to go to market and put a sizable trade, do you wait to the fix? Do you put it in as a fix? Do you go through an algo, or do you put it in at a specific time of day because you know that historically for the last day, week, 2 weeks, 1 month, that was the most liquid time of day in, for example, Euro NOK. Just an example. These tools exist and they're there for you to be used. Another one is the SDR view. So the DTCC put out and have all their trades on a database. What we do, and many others do as well, is basically take that database and serve it up on a screen so you know if at 2 p.m. today or at I don't know, New York cut, there's a very big option expiry which is in the market and you need to execute against the same currency at a similar sort of time. You might want to front run that, or you might ultimately want to think about how you access market for liquidity when there's this big expiry that is coming to market that could affect the underlying spot. Some of this might sound complex, but it's not that complex when essentially we walk you through. I've got 15 minutes to go through this stuff, so there's a bit of a challenge here. But my point there with particularly the SDR data, it's public domain information. All we do is serve it up to you. It is there, you can access it. So that said, right, that's just some of the things that I guess you want to consider, and what next? So the first thing is, right, we know these changes are happening. They're here and now. Think big, think now. Use technology. It's available. Play to the puck, as we call it. So in hockey, that basically means if you think the puck is in that direction, start running before, unless you're on skates, that is, before he's hit the ball, if you will, or hit the puck. Think of the trends, right? There are some key trends that are happening that you need to, I guess, consider for your businesses. The first one is access. That's access to multilateral providers, so access to counterparties, access to liquidity, access to community and markets effectively. The second one's around automation, and that's automating what you can. I guess that's part of risk management to a certain extent. Looking at digitization of your business, use of data, use of big data, the operational efficiencies that come with STP. The other one's around regulatory compliance, making sure that you have business scrutiny in place. As corporates, we opened up by saying the whole idea of active risk, risk management is quite a scary one, and it's certainly not for all, but it's one to be considered. And you'd want to make sure that business scrutiny is in place, and that certainly you're trading on regulated venues. The last one is around risk management, which goes in hand with what we've just discussed. So that said, the third one is around hire a compliance manager. I mean, I put that on there because it's in my view a must if you haven't already done so. They're very much in demand, so they might come at a premium, but that does give you a bit of peace of mind in terms of the complexity of the regulatory framework and landscape right now. And finally, consult your partners, right? Your Partners will help you deliver parts of your treasury mandate. So lean on them, right? They've been doing things for many, many years, whether it's KYC, where it's access to multilateral liquidity, access to regulated venue, things like trade reporting. I've spoken to many corporates around trade reporting, and many have not put anything into place and rely on their banks to do this for them. There are systems there, and that you can adopt them straight away. So that said, right, my conclusions, and you may or not agree with me, are the following. So the first one is one size does not fit all. You got to look at your business and understand what your needs are. The second one is, review your hedging policy. Examine how you can best serve your internal business, because, active management is certainly not for everybody. But having said that, the recent changes do suggest that pure passive is not optimal, so it does need to be considered. So the end of it is basically one of two things. You either end up looking like the guy on the right-hand side, or you look like the lady on the left. It depends on what your needs are. And with that, thank you very much.